I was intending to wrap up the discussion on what I look for when I trade, but I was about to totally miss a pattern that I really like, so one extra week. And I've got a trade set up for you on the EURCAD. Be right back. Hi, this is Tim from TradingStrategyGuides.com. Today, I had hoped to be wrapping up the training on what to look for to find these setups. But I totally skipped a pattern group, so I'm going to extend the pattern recognition training through next week so I can do proper justice to the last pattern group. I've also got a great setup on the Euro-Canadian dollar Forex pair today. Let me know in the comments what you'd like to see me do analysis on. Obviously, I can't manufacture a setup out of thin air, but I do find a lot more setups than I can share in 3 videos a week, so I can share the setups that make you guys the happiest. I want to look at our open trade. Yes, there's still only one. And the new setup, and then we'll get back to the pattern recognition training. Remember, you can speed this video up by clicking the gear icon in the lower right of the video and selecting a new speed. Well, let's take a look at our open trade. And Dish Network was our last open trade. Dish closed 7 cents inside the range right there. But rules are rules. I think the range is in a good place because of this candle body right over here. So I did spend a little bit of time trying to justify leaving this trade in at 7 cents below the range, but I don't think that I can do it. So I'm taking a loss right here. August was not too good for us. Every August trade was a loss. But drawdowns happen. I have confidence in my strategy, so I'm not stopping. And just so you know, I'm not saying that to try to convince myself. I'm saying that so you guys understand. This happens sometimes. So let's take a look at the EURCAD. We had a blown descending triangle on the EURCAD a few weeks ago, right over here. It pushed to the upside, so I didn't get into the trade. That negated the pattern because I don't take a break to the upside. In my opinion, the high probability trade on the descending triangle is only to the downside. The descending triangle consists of a strong support level, which we have right here at 146.06, and that's been tested a bunch of times. 3 times there, several times back in here. And then you have a series of lower highs in the form of a downtrend that puts increasing pressure on this support level, hopefully eventually breaking through. We expect price to break down from this pattern, hence the name descending triangle. Remember, however, that nothing is 100% sure, so never bet the farm. Always maintain your risk parameters. Ideally, these consolidation patterns should also show a decline in the volume and volatility over the course of the pattern. That's an indication that traders are getting bored with the pattern and are ready for it to break. In this case, the daily volume bars are declining with the exception of this little spike right here. Remember that these are not always pretty and symmetrical. There will always be anomalies due to random world events or some talking head running his mouth and scaring traders into doing something. So this volume spike happened on this push up right here, and much of that volume was stopping this move to the upside and pushing it back down inside the triangle. Also, remember that these volume bars represent the volume on that particular day, or in the case of most Forex feeds, it represents the number of trades executed on that day. So these bars will react much more quickly than the moving average line, which you can see is lagging and just started to move down the last few days. We measure the volatility using the average true range, or ATR. Volatility is simply a term we use to describe how much the price is moving around. The ATR is an average of the length of the last, in this case, 14 candles. You can see here that it is making much lower lows and lower highs, which is the very definition of a downtrend. Typically, we would expect this pattern to break somewhere in the last 1/3 or 1/4 of the pattern. And as always, I want to confirm the break with a candle close below, and I want to see sufficient volume on the breaking candle to be able to take the break seriously and keep us from being tricked by a head fake. So here's the trade plan. We will sell a daily close below the triangle or below 146.06. On the breaking candle, to enter a full-size position, I want to see this volume bar reach up to this volume average right here or beyond. If it doesn't reach the average but does at least reach 75% of the average volume, I will open a half-size position to reduce risk. You can calculate the percentage by taking this volume number right here, dividing it by the volume average here, and you should get 0.75. If you don't get at least that, don't enter the trade. The stop loss will be 1.5 times the ATR, and the first target will be 1 times the ATR. So the ATR is serving two purposes for us here. It measures volatility, but it also gives us our targets and stop losses. On the breaking candle, look over here at the ATR, multiply that number by 1.5 to determine the stop loss, and then place the stop loss order above the actual entry. So you measure it from the actual order entry and put the 1 ATR target ahead of the actual entry. If, after entering the trade, we get a candle that closes back inside the pattern here, we will take the loss right then and not wait for it to hit the stop loss. Our intention is that a breakout from these patterns should be explosive and hit our target fairly quickly. If the momentum goes away, we want to shut the trade down without taking a full stop if possible. When the price hits our first target, we will close half the position for profit and set the stop loss to break even on the remainder. We will then follow stops as price moves in our direction until the market takes us out. I typically do this by using two positions. The first position has a hard stop loss and a hard take profit at the appropriate prices. The second position will have a hard stop loss and no take profit directly associated with it. And that's our EURCAD setup. Okay, let's talk some more about pattern recognition. In part 1, we looked at the descending and the ascending triangles. In part 2, we looked at the bullish and the bearish continuation triangles. And last week, we looked at the bull flag and the bear flag. When I initially planned this series, I totally forgot a pattern that doesn't happen very often, but I love to see it when it does. So this week I'm going to cover trading ranges, and I'm going to have to extend our pattern recognition to one more week and talk about rising and falling wedges. I was going to try to do them together this week, but I don't think I'll be able to do the wedges proper justice in a short amount of time because they're a bit more complex than most of the triangle patterns. So today we're going to talk about trading ranges. A trading range consists of a strong support level and a strong resistance level, with the price bouncing back and forth between the two like so. Officially, there should be at least 2 touches of each level within the range. 1, 2, 1, 2. But one of my problems as an early trader was reading the definitions of some of these patterns. I knew going into my trading career back in 2004 that I excelled at pattern recognition. In fact, the point when I realized that I was good at picking out patterns was the point I realized that I would probably be good at technical analysis. Unfortunately, I got caught up in a bunch of training exercises that took me away from what I realized was my strength. So I spent years trying to trade everyone else's way until I finally realized that I had gotten away from my real strength. I said all that to say this: don't get caught up in the official definitions of these patterns. In fact, that's part of the reason I don't use the harmonic patterns. If you spend too much time in measurement to be sure that a pattern conforms to the standard, you're going to be wasting a lot of time. Just get used to eyeballing the patterns. And you start that by drawing lines where you think the pattern is. After a while, you can see the patterns before you even draw the lines. In my experience, the level of conformity or the symmetrics of the pattern doesn't seem to have any effect on the performance of the pattern at all. Hence, you see a lot of sloppy patterns in my trading. So don't look for perfection in a pattern. The pattern is a representation of human emotions. Human emotions can't be defined precisely, so the patterns will not be precise. And each new pattern you see represents the emotions of a totally different group of people than all the last patterns that you've seen. And always remember, a line is never just a line, it's always a zone. If you've seen my pattern trading videos before, you've probably seen this slide. Okay, let's say that this is a support line that you've identified from somewhere in the past. You look to the left on the chart and you found a price where there were a lot of bounces. Now, if you see that support line, so do thousands of other traders. So everyone is expecting some sort of reaction at that level. Some of those traders will say, I think price is going to bounce from this level and I don't want to miss it, so I'm going to put a buy limit order just ahead of the line, or just above the line in this case, so I get in the trade before it hits the line. So when it hits the line and reverses, I'll be in it and make a bunch of money. Then there's another group of traders that are going to say, I think price will bounce from this level, but I also think that it will push through the level first, then reverse back to the upside. So I'm going to put my limit buy order just below the line so I get a better price and I can increase my size and reduce my risk, because I can take a smaller stop if this doesn't do what I expect it to do. Then at some point below the line, there will be a group of traders that's going to say, well, this line has failed, so I'm going short from this point, and they're going to place a sell stop order down here, or execute a market sell when price drops to this, and that's going to drive the price down. So as the price approaches this line, you'll see stalling and jumping as these orders are filled. It's kind of fun to watch. Watch a live chart sometime when a strong support or resistance level is being approached by price, and you can see the stalling and the jumping and moving around back and forth like a knife fight is happening. I like to say that. And the winner is, of course, the group of traders that have the most volume at a given price. And so if it's these traders right here, then price is going to reverse before it hits the line, moving the zone up to this point. And if it's these traders down here, the price is going to push through and it's going to move the zone down below the original line. And of course, these people down here are going to see price push on through, and that's going to move the zone down to the lower level as well. And of course, if the line fails, well, it's still a line with evidence from the prior price action, and price could then approach it from the bottom and the reverse can happen. And every time price approaches this line from either direction, you have a completely different combination of traders. The early entry and the late entry traders that will smudge that line even more. Hence, a line is never simply a line, and price will rarely react at the exact same price every time it approaches that line. So what I'm saying here is the patterns are never perfect. There will always be candles that push through or don't quite reach the line, but if they're close, then consider it a test of the line. If you look for perfection every time, you'll not find many of these patterns. When I draw lines for these patterns on the daily chart, I typically try to contain all the candle bodies, but I don't worry about containing all the wicks. And that's the reason that I look for a daily close outside of these patterns, and I won't take a simple break of the pattern. So, back to the trading range. This particular drawing shows a perfectly symmetrical trading range. They are rarely this perfect. In fact, I dare say they are never this perfect. This is just the ideal. So let's look at a few real ones. Now, I've gone back on the charts and I've cherry-picked these because I wanted some good examples for you to see. Here's a daily chart of the cryptocurrency Ethereum. This trading range started in early to mid-May, right in here, and finally broke through on June 21st, right here. You see this range is sloppy with lots of touches on both sides. Some push-throughs, more push-throughs. Some didn't quite make it, more didn't quite make it. Several push-throughs on this side, push through here, didn't quite make it here, and so on. I drew the lines to contain the candle bodies, but I didn't worry about the wicks too much. You can see there was also a very nice decline in the volume and the volatility throughout the pattern. You won't always get this throughout the pattern, but I like to see it at least near the end of the pattern. When the candle finally closed outside of the range, it did so on really nice volume, you see. The entry on the close of this bar was 296.25, and it hit the first target of 311.79 on the very next day. Now, obviously, we're looking at this pattern after the fact, and here's something you need to think about when you look at patterns after the fact. This dotted line right here is probably where I would have had the resistance level for this range before it reached these candles right here. And I probably would have bought half size on this close outside of this range down here because the volume did not quite make the average. It did actually only make about 76% of the average, but that would be sufficient for me to take a half size trade. When it closed back inside the range right here, on the very next day I would have closed it and taken the loss. Now that would have been a half size loss, and of course our stop would have been down in here somewhere, so that would have been a relatively small loss right there. But when I realized that the volume was still dropping after that point, then I would have redrawn this range to include that close, like I did, and would have gone ahead and taken the trade here. So don't give up on a pattern if you fall for a head fake. They happen sometimes, and there's nothing you can do but to fall back on your rule set and move on. I've had several questions about how to avoid head fakes. My reliance on volume and volatility is one way to do that. This was a head fake, and like I said, I probably would have entered the trade right here, but the volume wasn't sufficient to take a full-size position, so I only took a small loss. Then, since the volume was still dropping in the pattern, it gave me confidence to redraw the pattern and take the break over here. The point is, you're not going to avoid all your head fakes. No one knows what the market is going to do in the next 5 minutes, let alone the next 24 hours. So don't let anyone tell you that they have a strategy that wins 100% of the time. It just doesn't happen. Always maintain your risk parameters and you'll be profitable, even if you get caught in a head fake. The next example is a daily chart of the E-mini S&P 500 futures. This was an actual trade that we took in early August, and it worked out quite well. You can see the range was not perfect because this didn't quite reach it, and this pushed through right here. And there's a little bit of a trend up on the bottom there, but it still worked. We entered at 29.5175 short, and it hit the target on the very next day right here. And now it's back in a new trading range actually, and I noticed this while I was setting this training up, so I guess this is going to be our setup for Friday. I'll have to take a closer look at it on Thursday. Anyway, you can see we had a nice volume drop and a nice volatility drop during the course of this range, and then an explosive move on big volume right here. And that's exactly what I want to see. And of course we did well on this, 61.75 on the second half, and that's our S&P 500 example. Moving on, here's an example in the Forex. This is the daily Great British Pound Japanese Yen chart. Here's another example of a range that had a head fake on less than average volume right here. This dotted line right here represents where I probably would have had the range before this happened, and then I would have taken a short right there on that close, and I would have taken the loss 2 days later right here. So as you can see, that was very small loss. It was on less than average volume. In fact, I didn't check this. It could be that this was less than 75% of the volume, which would have kept me out of that trade. But as you can see, the volume continued to drop off here after that head fake, so I was still confident that we had a valid range here. So I would have been prepared to take the sell right on the close right here. That's the psychological part of any strategy, taking a loss and then trying the trade again. You can't let the loss freak you out. In fact, if losses freak you out, trade tiny size and gradually increase your size until you get used to it. That's the only way you'll be successful. Plus, back testing your strategy so you have confidence that it works in the long run. Like I said the last several weeks, I want you to pore over hundreds of charts looking for these patterns. Look on all time frames, look on all markets. These patterns happen frequently. Just remember, they're rarely going to be perfect. After you've looked at a bunch of charts and you've drawn a bunch of lines, these patterns will start jumping out at you, and you'll see them as soon as you glance at the chart. And that brings me to today's trading maxim. Again, I'm drawing from the archives, but I think it'll be helpful. A maxim is a general truth, fundamental principle, rule of conduct, or a proverbial saying. These maxims come from various sources: books, the internet, coaches, teachers, other people. The purpose of my maxims is to motivate me to discipline in trading and in life. I suggest you start your own list of maxims to help in your trading. Things that you can say to yourself while you're trading to make sure that you always do the right thing. Feel free to borrow from my list. And here it is. Tim's trading maxim number 16. Just because it's a winning trade doesn't make it a good trade. Just because it's a losing trade doesn't make it a bad trade. Good trades follow your plan, bad trades do not. I probably told this story a bunch of times since I've been training traders, but I figure if I went through this, then other traders probably are as well. When I started trading, I got this great future strategy and was trading it on the mini Dow Jones. I would successfully trade it a bunch of times on paper. Then I would go to my live real money trading account and I'd take a loss. Now, I'm not talking about a huge account here. I think it was about $7,500. But the strat required me to use 2 contracts and take about a 100 tick loss on the losers. The mini Dow is about $5 per tick per contract, so I was risking like $1,000 plus commission on each trade. So after taking a loss on the live account, I figured I must be doing something wrong. So I would go back to paper trading and win several trades in a row. And then of course the next time I would trade live and I would lose. And I went through that cycle several times over a few days until I just had too little money left in the account to continue. You see the problem here? I was following the rules to the letter, except I was taking all the winners on the paper account, taking a loss on the live account, freaking out, going back to paper, blah, blah, blah. Had I just stuck to my guns, I might have been successful, except I was risking way too much per trade. I think that first trade was like 13.5% risk or something. But that's a story for another day. Just remember, analyze all your trades, winners and losers. If you followed your rules, then they were good trades. If you didn't follow your rules, then they were bad trades. It doesn't matter whether they won or not. If you've got a good strategy, the winners will come. Remember our Euro-Canadian dollar trade plan. We're looking for a candle close below 146.06 to sell. If the volume is not quite average, go half size as long as it's at least 75% of the average. Your stop loss is 1.5 times the ATR. Your first target is 1 times the ATR. And remember to check out the trade management video. The link is below. If you like this video, or even if you didn't, go sign up for my free Trading Picks email list to be sure you don't miss any of these picks. I'll be sending out about 3 or 4 trading picks a week, everything from stocks to futures to cryptos to Forex, and you'll get to see them first. Plus, you'll get first notifications of anything special that's happening. And you know what? It's free. I'll put the link below this video. Be sure to come back to Trading Strategy Guide's YouTube channel every week on Monday and Friday for my analysis videos, and Wednesday morning for training videos, which will most likely include a trade setup like it did today. Thanks for all the input you guys are giving me. Continue to let me know what things are bugging you about your trading or about my trading. I'm up to explain anything you guys want me to explain. Just don't ask me what the meaning of life is. Just let me know what you're thinking, okay? Also, follow me on Twitter. I'll put my Twitter link below. Tell your friends about us and help us make this the best trading channel on the internet. As always, thanks for watching, thanks for subscribing, and don't forget to hit the thumbs up below. Have a great remainder of your week, and I'll see you next time.